A minute ago, you glanced at your silver chart and saw $75. Now I want to talk about a completely different number, one that showed up quietly inside technical disclosures and manufacturing roadmaps. A number that major automakers are willing to sign production agreements around. A number that, if you understand what it implies for global silver supply, makes $75 look shockingly disconnected from reality. That number is 1, as in 1 kilogram of silver per electric vehicle battery pack. Not 1 gram, not a few grams, a full kilogram. And before you assume that has to be a misunderstanding, slow down and run the math. The discussion around Samsung's silver carbon solid state battery architecture points to up to 5 grams of silver per cell. A typical 100 kilowatt hour EV battery pack uses roughly 200 cells. Multiply it out. That's about 1,000 grams of silver, 1 kilogram, inside a single vehicle built on that platform.
If that silver intensity holds through commercialization, it doesn't just increase demand, it changes the entire scale of the demand conversation. And what I'm about to lay out isn't a hype prediction. It's a supply and demand reality check built from the same categories of data institutions use: corporate development updates, inventory trends, delivery pressure, lease rates, and bank research targets. The point isn't to promise you a price. The point is to show you why the current price may be reflecting far less of the future demand curve than most people realize. Start with perspective, because without it, the 1 kilogram figure won't land the way it should. Conventional lithium-ion EVs today typically contain something like asterisk asterisk 20 to 50 grams asterisk of silver, largely tied to electronics, connectors, and control systems throughout the vehicle. That's been the baseline assumption behind the EV demand support silver narrative for years. The silver carbon solid state design being discussed is different. The story is that silver isn't just scattered around the car's electronics. It's integrated into the battery architecture itself, including a very thin silver carbon composite layer that's positioned as part of what unlocks the performance claims: long range, very fast charging, long cycle life, and improved durability across temperature extremes. And the performance numbers being associated with this technology are exactly why this matters. We're not talking about a marginal improvement. The claims include things like asterisk asterisk 600-mile range, around 9 minutes to reach 80% charge, lifespan targets measured in decades, and cycle life numbers that sound more like industrial storage than consumer EV use. On top of that, the narrative says pilot production has been progressing with increasingly credible yield rates and field testing across harsh temperature ranges, showing relatively limited degradation after hundreds of cycles. In other words, whether every marketing claim hits perfectly or not, the reason markets would take this seriously is simple. If the technology is good enough and mass production is already being prepared, adoption becomes a business decision, not a science project. Now connect that to automakers. The discussion includes a binding mass production agreement targeting the asterisk asterisk 2027 model year asterisk, with premium vehicles positioned as the first rollout. There are also reports of ongoing validation projects with other major manufacturers, including evaluation vehicles incorporating these next-gen cells expected as early as asterisk late 2026. That matters because timelines like that don't describe maybe someday. They describe the supply chain is being built now. Now do the demand math, because this is where everything starts to feel uncomfortable for the supply side. Global EV production crossed roughly asterisk asterisk 20 million units in 2025 asterisk asterisk by widely cited industry estimates. If only asterisk asterisk 20% asterisk asterisk of that EV segment transitions to a 1 kilogram silver per pack architecture by 2028, so just asterisk 1 out of 5 EVs, the incremental silver demand implied by that one application alone works out to roughly asterisk 16,000 metric tons per year, or about asterisk 514 million ounces. That is not a small new use case. That's on the order of asterisk more than half of annual global mine production asterisk from one battery chemistry under a partial adoption scenario. And if you're staring at a $75 silver chart, the uncomfortable question is how much of that curve is being priced in today? Because the answer may be not much. Now, here's why this isn't just exciting upside. The reason the Samsung number becomes alarming is because silver is not entering this potential demand transition from a comfortable surplus. It's entering it after years of structural strain. Industry reporting has pointed to multiple consecutive years where demand exceeded supply, deficits measured in tens of millions of ounces annually. Numbers being circulated include a projected deficit in 2026 around ** 67 million ounces, following an estimated deficit around * 95 million ounces in 2025, with multi-year cumulative shortfalls described as hundreds of millions of ounces. Whether someone agrees with every estimate or not, the direction is what matters. The argument is that above-ground inventories have already been doing the heavy lifting. And you can see the tension show up in places that are hard to hand-wave away, like exchange warehouse dynamics and deliverable coverage. Comex registered silver, the category tied most directly to immediate deliverable warrants, has been cited around * 70 to 80 million ounces recently, while open interest can represent several hundred million ounces of paper claims. If you work out a simple coverage ratio using the figures being discussed, roughly * 76 million ounces registered versus * 576 million ounces open interest, you're looking at something like * 13.4% coverage. Let that sink in. For every 100 ounces promised on paper, there may be only around 13 ounces sitting in the registered bucket available for delivery under that framework, assuming those reported snapshots are accurate. And if most market participants never stand for delivery, the system can function. But the moment more participants want real metal at the same time, the structure gets stress tested. We've also seen episodes of fast warehouse withdrawals being highlighted, tens of millions of ounces leaving in a single week, along with unusually heavy delivery volumes in recent months. On top of that, the calendar matters. When first notice days approach, attention spikes because anyone holding a contract into the delivery window has to decide whether they're rolling, closing, or standing for delivery. Now step outside the US paper pricing view and look at physical premiums elsewhere. One of the most important signals in any commodity is when physical markets start pricing differently than future screens. Reports have pointed to Asian physical pricing running at meaningful premiums relative to Western paper benchmarks, with spreads in the high single digits to low double digits percentage-wise at times. When physical is consistently more expensive than paper, the market is telling you something simple. The immediate metal is harder to source than the screen implies. And then there are lease rates, the plumbing cost to borrow physical silver. When lease rates are near historic norms, nobody talks about them. When lease rates sit several times higher than normal, it suggests tightness in readily available physical supply. The numbers being discussed recently put short-dated silver lease rates around * 5%, compared to a historical norm closer to * 1%, with memories still fresh of earlier spikes that were dramatically higher during acute stress periods. In other words, even before you add a potential 1 kilogram per EV demand shock, the system has been showing signs of strain. Now let's address the most common dismissal you'll hear the moment you mention a demand curve like this. Mining will respond. More silver will be produced. Problem solved. That sounds reasonable until you look at how silver is actually produced. Most silver is not mined because companies wake up and decide to mine silver. A large share of global silver supply, often cited around * 70% plus, comes as a byproduct of mining other metals like copper, lead, zinc, and gold. That means silver supply does not respond cleanly to silver price the way a primary commodity might. Higher silver prices don't automatically flip a switch and create a wave of new silver mines. Supply expansion depends on the economics and timelines of other metals, permitting cycles, capex cycles, and geology. Meanwhile, global mine output has been relatively flat in recent years, often described in the * 820 to 850 million ounces annual range, with some projections suggesting limited growth or even slight declines due to depletion and disruptions. And disruptions are not theoretical. A meaningful portion of the world's silver supply is concentrated in a few key regions. Mexico alone is often cited as producing around * 200 million ounces annually, roughly * a fifth to a quarter of global mine output depending on the year. So when large producers revise guidance downward, cuts of several million ounces here, a few million there, that matters in a market that's already described as running deficits. On top of production guidance, policy risk can act like an accelerant. If trade policy or tariff frameworks restrict flows from a major producing region into a major trading/settlement hub, that doesn't have to stop silver to create price dislocations. In a tight market, even friction creates volatility. Now zoom out to something else that makes this moment feel different from the average silver bull story. A lot of the aggressive targets being floated aren't coming from retail forums. They're coming from major financial institutions publishing ranges that would have sounded absurd not long ago. There have been published bank scenarios that place silver well into triple digits under certain ratio compression frameworks or supply stress conditions. Other institutions have highlighted structural fragmentation in the silver market, especially around export licensing and regional inventory controls, arguing that the global pool is less one unified market and more separate regional pools, which increases the likelihood of localized shortages and sharp spikes. You can also track the flow narrative: reports of elevated silver imports into Asia, strong additions to Asian silver ETPs during certain weeks, and net selling or weaker flows in North American products at the same time. Whether every ounce stays put forever is a separate question, but the point is the same. Metal can move to where it's most wanted, and it doesn't always move back quickly. Now, I also owe you the honest counterargument, because anyone who tells you silver is a one-way trade is not being serious. There are real reasons silver demand growth might not be as clean as the bullish math suggests. Industrial demand can fluctuate. Solar manufacturing has been aggressively thrifting silver for years, reducing silver per cell to protect margins. There are credible substitution efforts being discussed, including moves toward copper-based alternatives in certain photovoltaic architectures. If solar, one of the largest established silver demand pillars, reduces intensity faster than expected, that removes some demand pressure. On the battery side, competition matters. Not every solid-state or semi-solid design uses the same materials. There are validation programs for alternative chemistries that may scale without heavy silver content. If those alternatives win the cost/performance battle, the 1 kilogram per pack scenario could be delayed, reduced, or confined to niche segments longer than bulls expect. And silver has already proven how fast it can fall. We just watched it hit record highs and then suffer a brutal drawdown in weeks, moves driven by margin changes, forced liquidations, shifting rate expectations, and leverage unwinds. When paper leverage gets extreme and then reverses, it doesn't unwind politely. It can look like an elevator in free fall. Geopolitics and inflation expectations also matter. If conflict premiums fade quickly, energy prices cool, and rate cut odds get repriced again, the fear bid that often supports metals can evaporate fast. So yes, there are risks, and if you're operating like silver can't drop, you're setting yourself up to learn the hard way. But here's what can't be waved away with opinions: the engineering arithmetic. If one battery design uses 20 to 50 grams of silver and another uses approximately 1,000 grams, that's not a chart pattern, that's a material intensity difference. If corporate disclosures, technical publications, pilot line progress, and signed production intentions translate into real manufacturing, the demand shock is not possible, it's mechanical. And then stack that on top of the existing structure being discussed: multi-year deficits, tight deliverable coverage in certain systems, physical premiums in key regions, elevated lease rates, and the constant reality that mine supply is slow and mostly byproduct driven. That's the gap. The gap between what the screen says today and what the supply-demand math could say tomorrow. Silver can stay mispriced longer than people expect. The screen never announces when it's about to catch up. It just does, usually violently, usually when the maximum number of people are positioned the wrong way. So the question isn't, does silver go up tomorrow? The real question is, what happens to price discovery if even a partial slice of the EV market starts pulling ** 1 kilogram per vehicle from a market that's already running lean? If this breakdown helped you see the bigger picture, share it with someone who still thinks $75 is just another normal day in silver. And tell me what you think is more likely over the next 12 to 24 months. Does the battery story actually scale into mass production on schedule? Or do substitution and competing chemistries slow it down enough that the market can absorb it without a price shock?